Imagine for a moment that you've plotted out a trading zone on your chart, and that is the area that you will need to see price visit before entering a position. Maybe it's a confluence of factors such as price pivots, a moving average, measured pullback via Fibonacci, and a round number. What do you need next? You need something called a trade trigger to get you into the position. When price gets to an area of interest, you don't simply jump into a position without some type of sign that the price is moving in your direction. Looking at this chart, we have a confluence of technical factors that include a former resistance area broken and is a Fibonacci cluster zone, B, a pivot level plus large momentum, C, a pullback to a moving average, D, it's not seen on this chart, but also a 50 level. Now, if you were just waiting for price to enter your confluence zone and not a trade trigger, you can see you were taken out with momentum. Another positive about waiting for a trigger is you won't just jump in to a large bear or bull candle by letting emotions take over. Not only can these candles signify a temporary exhaustion in the move, but you can also get some large slippage as you market entry into the trade. If emotionally entering a trade because you see a large candle, yes, people do that, then you clearly don't have a trading plan. And really the first order of business, get a trading plan. So we need some type of trigger to get us into the trade in an objective manner that shows, at least at the point of a trigger, that price is in our direction. Now I'm going to look at three methods to enter your trade. And for all the examples, I'm going to use the same chart as the last one we just saw. These may not be how the textbooks describe them, but oftentimes there's a large discrepancy between trading books and in the field usage. So market structure for triggers. I am a fan of market structure in trading, and not only can it signify areas of interest, but also are valuable for trade entries. Understand that price moves in waves, and in our sample chart, our uptrend needs higher highs and higher lows to remain intact. A downtrend would need lower highs and lower lows to stay intact. It would make sense to use that last swing high as a reference point to enter the trade. Once price breaches the high after it hits your zone, you could enter the trade. The issue now becomes position size and risk because it is a large distance between our zone and the high of the last swing. There's a trade-off between confirmation of the move and your stop placement, which could leave you with a trade with a very small position size if you're using a percentage of account risk method. You can see, however, that there was not a trade trigger, and you would not have suffered a loss on this trade. Trade triggers with indicators. A very objective method of trade triggers is using an indicator cross or turn to alert you to entering the trade. How close you are to entering to the turn will depend on the indicator and setting that you're using. Now, this is a 14-period CCI that we can use for a trade trigger. There are a few methods you can use to give yourself an objective trade entry when price enters your trading zone. One, this is where the long shadow shows up, and drawing a simple trend line on the highs of the downsloping CCI does not give you a trend line break and therefore no trade. Two, price does give a slight bounce off of the zero line, but price never makes it high enough to trigger a trade. Waiting for a simple CCI signal would have prevented you from entering a trade after a very tempting reversal candle at your trading zone of interest. To add a little more confirmation, you may want to place a buy or sell stop a few ticks or pips off the lower high of the candles that turns the CCI. This will ensure actual price movement in your direction, although the breach of a high or low of a single candle does not really hold much significance. Trendline break trade triggers. Trend lines are used by many traders to help define trend direction and even trend strength through the use of fanning trend lines. The way you use them to define the main trend is also how you can use them to show a break of the counter trend move or the retracement. The chart we have been using makes it difficult to use a trend line at this point because you want to connect swings, and there are really no swings to speak of at this point. There is another way to draw trend lines, and that is simply having the line hug the shadows or the extreme of the body candle range. The black line here, it's an example of just connecting the upper shadows and then entering the trade on a strong break of the line. The solid red trend line is plotting out the highs, and the dashed red is an attempt to join the high with a sloppy swing high. Regardless of the reds you used, there was not a trigger when price entered the trading zone. Now, nothing is guaranteed, but having an objective means to enter a trade keeps all emotions out of the trading equation, and that is a huge step for many traders. Now, when trend lines break, there's often a retest of the lines, and that can cause many traders to panic out. Support and resistance can be very arbitrary, and oftentimes we'll see price test, like break the high, fail, and then drop after you're in the trade. The CCI is one step removed from current price, as it does need price to calculate. Now, in the end, what really matters is that whatever you use, it's something you're comfortable with and will be consistent with. There are many ways to swim a river, and that's the same for trading. There's no one right way to trade. The objective way to enter trades takes emotions out of the equation, and it further cements an objective trading style where your rules do what they are designed to do.